public filing of the next construction technology IPO, which we will talk about. We will then have Tom from Civ Robotics coming on and talking about their, they have a layout robotic. They also, which I understand now, also doing driving piles for large solar farms and maybe other infrastructure as well. And then if we get there, we will talk about, whilst I was finalizing my research for this episode, I saw this clickbait headline on LinkedIn, very relevant to us and our audience, which says, why construction roles are booming. So we will try and find out and dissect that. But before we go there, Dustin, you want us to do a shout out or something that you're doing with DataGrid, right? So let's quickly do that.
Yeah, if anyone is going to be in San Francisco, we're hosting an event on the 23rd from 11 to 6 p.m. And it's going to be us, DataGrid, a bunch of builders, and it's an agent-a-thon. So we're just going to like show you what AI can do, some of the directions Edify is going, some of the things that DataGrid are doing. So we should have some live demos. I'm doing a talk about where I see this affecting pre-con. DataGrid will talk about what they're doing for customers just to help build agents that connect disparate systems, because we still have a lot of data that isn't interoperable between workflows. So yeah, if you're in San Francisco and want to come by, you can find the registration on Edify or DataGrid's LinkedIn. Yeah, and there's some spots left. It'll be fun all day, 11 to 6. And yeah, come by.
Very cool. Sounds good. Looking forward to hearing about it. Okay, nice, guys. Let's dive into carbon accounting then. So shall we tell people what carbon accounting is for people that didn't know? Because I will admit to you all that I was not 100% certain on what the exercise was before I started researching for this episode. So I'll give a very quick explanation, and then we can dive into some news that came out recently about one of the largely funded carbon accounting companies that were recently acquired. So shall we do that? Carbon accounting. So carbon accounting is where so companies have to measure how much carbon they emit as part of this existence. So in order for this company to operate, they let off or they emit carbon. And what companies can do to offset their impact of the carbon that they emit is buy carbon credits. And each credit that they have usually represents around 1 ton of CO2. And what they can do with these carbon credits is put the credit into like a project which takes CO2 out of the atmosphere. So typically this is like reforestation project, or planting trees, protecting like a forest that maybe was a threat of existence or whatnot. And then what this kind of incentivizes is that companies are reinvesting back into making the climate a better place as part of their operation. And what then emerged as a result of this incentive were a number of companies, carbon accounting software companies and consultancies. And I think there was a big boom around the 2021 to 2022 era, where a lot of venture capital was put into the software, which helped to calculate how much carbon a company was emitting and the impact of their operation on the globe. And 2023 to 2024, a lot of the policy specifically within the EU changed, and suddenly carbon accounting was not so much of an initiative or requirement for smaller scale businesses. It went much into to larger businesses. And so let me stop there to start with. Does anyone have anything to add with their experiences on carbon accounting? Then I'll go into some of like whether the whole idea of carbon accounting was a success or not, because there are a few interesting investigative journalism pieces on the success of some of these projects that were funded as a result of the carbon credits. Patrick,
I don't have much to add, but I think there is one thing that is interesting in the market, Owen, and that is, so when we think of carbon accounting, I think the brain immediately jumps to software, but actually it's a very service-driven market, because a lot of the accounting has to do also with, okay, can I get a third-party verification of what's actually going on? So it's a very service-driven market. So when we speak of this market, the size, etc., we need to differentiate between, okay, what is the software? There's core software, there's narrow software, there's software platforms, but also what is actually the services that are being rendered. Oftentimes services are being rendered by third-party consultants, and there's actually a surprisingly large part of the market which is also done by non-profit organizations on the service part of the market.
Okay, Fine. Dustin, you were going to say something?
No, Patrick kind of nailed it. I just, I've had my experiences with carbon accounting come mostly in trying to figure out the carbon footprint of a particular construction project. And there's been a lot of like push to estimate the carbon footprint in pre-construction before the project's even built, which is a tremendous amount of effort for a result where your level of confidence is virtually zero that you actually understand the carbon footprint of a particular construction project. Why I chuckle is when I was at Autodesk, they were very big on that carbon accounting and everything would be front and center of every project by now. In fact, it's something that they built into their new estimating tool really quickly. And it's like, at least in the US, they don't really care about it.
Yeah.
So it's just the fact.
Yeah. And how accurate can you be carbon accounting in the initial stages of a project when, one, so many things change during like the initial stage from estimate to actually what's installed, and two, are you then controlling every single element that goes into the building? Like, okay, drywall, for as an example, insulation maybe is specified, but I've been on plenty of sites where the actual product that's specified doesn't actually end up being the piece of product that the installers put into the building. So whilst you might have all these carbon calculations, I doubt they're actually the things that end up in the building, thereby making the carbon calculations very inaccurate.
Well, I think the amount of labor to make carbon accounting extremely accurate would make it completely unjustifiable.
Yep.
And so you might as well just say, hey, based upon this project's metrics, here's kind of what we expect that project to be worth, and set some standards and just leave it at that. But we seem to want to go into these high fidelities, and then we're creating so much work, and you're like, the marginal level of confidence is just not worth it.
Yeah, it's almost
and
like,
you can't control it enough. You're like, okay, well, do we also count like where are vendors traveling from? So now you're looking at sourcing and logistics, and this just becomes a nightmare. You're just never gonna be able to do it.
take this absurdity, right? I mean, the metaphor that shows the absurdity is, okay, you want to take your weight of your body, here's a scale, okay? And then that scale might not be perfect, but perhaps the scale has been certified, etc. But because you're actually putting your body onto the scale, you can plus minus the margin of error of the certification of the scale, know what today you're weighing. Okay, but now what we're doing with carbon accounting in construction is quite different. It is in this metaphor, hey, I want to know what my body is likely to have weighed. I'm using the future past tense, to have weighed in 3 years from now minus 1 day. And because I can't put my body on that scale, in order to know that today, I now deconstruct my body into different parts. And now I'm making proxies and assumptions of things that might be what my body is made up of at that point in time. So let me not exactly use my arm, right? But so let me use an arm of perhaps a human. And then I'm putting all of that together. And in the meantime, I'm becoming obese, I'm doing sports, whatever. But hey, today I will know what I will have likely weighed in 3 years minus 1 day. That's the absurdity.
But on average...
Martin, sorry, let me just say one thing. When preparing this, I was going to make an analogy. But Patrick, I knew that, maybe in the back of my head, you're the master of analogies here, so I'm glad that you've done that. Martin,
actually, I'm not. My partner is, but thanks.
Martin's Frankenstein measuring, or Patrick's Frankenstein measuring scale. Just throw body components.
Martin, you were saying something?
I mean, I was going to say that it doesn't matter what the weight is in 3 years because it's 70% water anyway. So it's completely irrelevant. It's completely irrelevant in the subject. But my experience with carbon accounting is unfortunately next to zero. Having participating in around 1,500 small, medium-sized residential commercial projects. None of these require any carbon accounting and checking, because I think that's a luxury of larger projects, and the real small economy, I would say, don't care because there's no budget for it. That's my reality, and I think to sum this, I think recent investigations by The Guardian and The State, I think, Patrick, that's how it is pronounced, up to 90% of the certified rainforest offsets were worthless. Phantom credits that didn't actually reduce any emissions. Yeah,
I did not see that coming.
So it's heroes in my understanding.
I mean, generally speaking, I think it's really good that people try to offset their general carbon footprint, but I think this sort of like, let's do a forensic accounting of every single project is where you just are adding unnecessary burden and cost to anything, where you're getting actual no realized value from it. It's just it's not a tax, but it's a cost to the business that just makes things more difficult. I guess it stimulates the economy for consultants and charities.
Yeah.
What was the stat? 2022 to 23 or 2021 to 22 is like $860 million of funding into this space for software developed.
So I can give you the total. I pulled it right before the call. So in total, into carbon accounting software, not services, carbon accounting software, the venture market has put 2.3 billion.
Yeah, it's been a lot.
So and just excuse
what's
my
the
simple
value
understanding of this. This is just basic software which calculates the carbon emissions a company is producing. Why the hell does you need so much funding to do this? Is there something special about it?
Different UX colors, different software vendor. I don't know. I'm asking. I don't know as well.
A lot of it came before 2023. So a lot of these 2.3 billion. You also have capital concentration, as always, in our categories in 1, 2, or 3 very good companies. So, for example, Watershed or Persephone. In the US, are 2 of them, which have more than one functionality, but still sit within the carbon / maybe you could give them also saying ESG accounting to have it perhaps painted as a slightly broader category. But look, I mean, my contention has been, and I stick to that, I think that's as much funding raised as there is market size.
That's not usually a good ratio.
No.
Yeah.
Good. And I think that, Martin, to your point about the 90% of the projects being worthless, from what I also found is that there was like a value to these carbon credits, so you could buy cheaper ones or you could buy expensive ones, and companies ended up just buying the cheaper ones to offset their carbon. So it gave the illusion that they were doing something, but when in fact those cheaper credits actually were too cheap to have any kind of impact or do anything worthwhile.
Oh, in 2022, I'm sure that there was a crypto exchange fully dedicated to this. Because why not tokenize it?
Yeah, I definitely spoke to a few companies that were talking about tokenization of this back then.
But
like I still don't understand, like, where are these offsets going? Like, if you buy credits, like, what happens with the dollars that you put in, and how
it plants a tree.
What's the percentage of these dollars? If you put 100, what's the percentage of this 100 that goes into real green?
No one can say that, Martin, right? And so that's why if you want to okay, so I'm going to say something which I cannot validate, and I'm not saying it's what's happening, okay? So please, dear post-production cutter, don't piss me off by again making a sensationalist statement that is out of context. This is the instruction for the AI, okay? But if you wanted to launder money on a really large scale, this would be a really nice scheme. Okay?
So the thing is,
I think no one can know, right? No one can control it. The reason why this market has such a big services market is because you have 2 types of services, right? So one is, sorry, I'm simplifying, but 2 types of services. You have data collection services and you have data validation services. And so the data validation services of this part is then actually supposed to do, okay, Martin, you bought this many offsets. Now I'm your service agent. And those of all the other buyers of these certificates, I'm now actually visiting the site in the Brazilian rainforest that actually someone can show me that this applies. Okay, you know what is happening now? So I'm having this nice time. I'm visiting the Amazonas region. I'm seeing this. I'm walking away. I'm writing my report. You know who comes next week? Dustin. Dustin is from a different company who validates another certificate. And Dustin flies to the Amazon region and is also, do you think Dustin knows if I was here last week? They are showing him the exact same region if they want to. I'm not saying that's happening, but I'm saying if you want to be fraudulent about it, it's a completely imperfect system that is just made to look like it's validating, but no one can, the Greeks say quis custodet ipsos custodes. That means who actually validates the validator. It's impossible in this one.
Yeah, I think actually Americans have a good attitude to it. They just don't do it. And like there's another, obviously just Gemini, but research suggests that massive chunk of money, 50 to 80% is absorbed by brokers, traders, consultants, London, New York, Geneva.
Well, it's like the question of if, how much of like government funding to like charitable charities and everything else actually goes to helping people versus administering like these programs. And it's a pathetic amount. The administration costs have just ballooned up for everything. And yes, Patrick, I am sure that there is some creative ways to move money around the world so that you're even just in better tax situations. Because if you control through subsidiaries the validation, you could be in one tax bracket somewhere else, and it's a very cheap way to move money around.
Yeah. Has any of you, as a fun exercise, I watched, I think it was Apple TV or Amazon, I watched before the holidays, movie about the biggest rally championship rivalry from the 80s, which was basically Audi versus Lancia. Two car brands from Europe. They were actually both extremely good. In rally days, Audi pretty much dominated the 1980s. Anyway, it's a decent movie. Nothing great, but if you're a rally fan, my father was an amateur rally driver, so I have whatever, I liked it. And looked into it, and there's this funny scene where if you want to have a new rally car that you can use for your brand, it needs to get, I think so I don't only know the German term, I think in English you would say homologation. So you have to produce a certain amount of cars. I believe it's 20 or 50. I think it's 20. Sorry, 200. 200 is the number. So you have to produce 200 cars, and that's the threshold in order for you to actually be allowed. So you can't build a prototype and put it onto rally. You have to produce at least 200 for people to buy. Okay, so in this movie, they show what Lancia allegedly did, which is, okay, here come the rally champion, the FIA auditors. They come to Lancia in Italy, I believe it's Torino, and they show them the yard, and they're like, they count. Hold on. This is only 102 cars. We have the other 98 cars at this other, because we didn't have enough parking space, we have it at this other, but it's lunch. Right. So why don't we go for lunch? And then afterwards, we take you to the other side. So the guy takes them to lunch. He makes sure they face inside. They can't see the window. And then outside the window, you see how the car transporters transport the cars to the other yard. And then they see that. It's a pretty cool metaphor, right? So if you can't actually control the system, what value does the validator have?
Very nice. Crazy. Very, very nice.
The sad thing that this is pushed into people as for a good cause, and people are making jokes, not jokes, but like having fun with it, really. That's just ridiculous. But
sad times. How about this acquisition that was announced last week? So carbon counting companies, Plan A was acquired by Lightspeed. Sorry, not by Diginex is the company, a NASDAQ company. Is there anything insightful to look into this? Does this add any weight to the conversation, or shall we move on?
I had some numbers last week. Actually, let's get into it. So, Owen, can you bridge me 30 seconds telling a bit more about the acquisition? Let me again find my notes on this. Let
me tell an interesting story. So, Lightspeed backed, Lightspeed being an investor, I believe. Plan A was the name of the company. They acquired $55 million, 55 million euros. And this was a part of a cohort of carbon accounting companies which received significant investor interest in 2021 and 2022. Based in Berlin, they were acquired by Diginex, which is a London-based sustainability regulation tech provider. Wow, that's a mouthful. And the deal values Plan A at 55 million euros with a 25 million euro performance-based earnout.
Okay, so here we go. So they raised from Lightspeed in total, I don't know, 40 maybe less. Perhaps you guys double check me on that one. But let me actually tell you the fun part of this, because here we have an acquisition where we can actually do forensics. Because Diginex is publicly listed, Diginex numbers are public. So Diginex, though a British company, is listed at the NASDAQ. So that means the numbers are public. So Owen, just to recapitulate, the deal that you just presented, the way it's public, 55 million valuation for Plan A, paid in stocks from Diginex. Is that correct?
That's correct. It was 3 million cash, 52
3 million cash,
stock.
52 million Diginex stocks. Okay, so
Yes.
Diginex has a revenue in the fiscal year of 2025, 2 million. I'm not making that up.
So Diginex.
I'm 2 million. 2 million revenue in 2025. It's public, so go and look it up. And that was after 2024, they had 1.3 million in revenue, and after 2023, they had 1.6 million in revenue. So 2 million revenue business.
What is their market cap right now?
Yeah, thank you for asking. So last week when I checked, it was 770 million.
How is it possible?
Can I go? I want to go. I want to go public over there. We have a unicorn.
Yeah. So
I've got some advice for
someone
you
in the
later
public
in the show.
market has given them whatever, a 300, 400x revenue multiple, not forward. So I'm using the fiscal year revenue right now, the 2 million, 385 million fiscal year revenue multiple. That should already tell you, okay, hold on, let me do more forensics. So that's one. Obviously, the price that you achieved per share is inflated because the business that is issuing you the shares is inflated. That's the first observation. The second is I then looked at the liquidity. So when you as an investor in Plan A receive 52 million in shares, 52 million in shares, and you acquire as Palantir or you acquire as Tesla, it's Apple, right? So highly liquid stocks, that means that value is also liquidatable for you, right? So it actually is as good as cash. In Diginex, it's the opposite. So Diginex is so volatile that it only trades between 0.5% to 0.8% of the float every single day. So in other words, if you wanted to sell 52 million of shares and the company held its share price, its market cap, which, whatever, right? It would take you almost 110 days in order to cash out. So that is impossible because during the 110 days, that would mean that you get every single sell allocation. Not possible. There are other sellers along the way. So most likely, because it is such an illiquid stock, you will actually take years in order to sell the shares, although it is a public business. Now, when you sell and it's extremely illiquid, you know what happens? It makes the stock super volatile. The price plummets. So actually, this is another reason why I absolutely hate venture-related PR from journalists that actually that are being used as mouthpieces and that actually do not do forensics in order to hype something up. Sorry. The 52 million in shares are issued, just facts, are issued by a company that is valued at 385 times of past year revenue and has a trading of its float of 0.5 to 0.8% in stock, meaning the 52 million should not be treated as 52 million. I don't think that's how Lightspeed or the other investors are treating it or accounting for it as in terms of fair value. So it's pretty cool that we could do this forensics because the acquirer was A, revealing the deal details, and B, is actually a publicly listed company.
What impact does it have on its I guess it's not only you who knows this, right? It's everyone who is in the business.
Public information.
So why does it exist at such a high valuation?
So look, okay, I can go. Dustin, you go.
Oh, I was curious. Are they on a major stock exchange, or is this like we have some shit exchanges in the U.S.
It's NASDAQ CM. NASDAQ CM. Yeah. So look, the acquirer benefits from the high share price. It does because obviously then they can actually use much cheaper. They have to dilute less in order to make the acquisition, right? So now I can make you 52 million offer, but because I'm totally overvalued, I'm giving you less shares for it. So that's something an incentive that the acquirer has. for the
Well, you know what
acquired
happened
party.
in this deal? You know what happened in this deal? That $3 million cash was that because this was probably done at a round that was sub any liquidation preferences. So the $3 million cash, I'm assuming, is going to some of the founders and some of the employees, or do you think it's going to the investors? Because they had to do it, and then they had to do some sort of earn-out carve-outs. Because, like, how are they even going to retain that team? I wouldn't be surprised there's an escrow account for the cash.
Yeah, it could be vesting on the shares too, but you might be right. I think that's quite likely structure, yeah. Yeah, because also the investors, what do they do with 3 million after they put that much in? Yeah, it's so that takes me to the incentive for the acquired party. I mean, it looks damn good, right? To say on your resume you have a 55 million exit and no one asks questions.
Yeah.
Crazy. Shall we move on?
Mhm.
Okay, so do you all know? Actually, firstly, let me ask you all a question. As I know, we have discussed a couple of times on here some opinions on Apple's kind of view and stance and strategy towards AI. So, does anyone have any particular thoughts, insights into Apple as to why they have kind of sat back a little bit with when it comes to the AI race? Like they haven't been forthcoming with any particular product releases and so on. So, Martin.
If you look at what Siri was capable, what is capable of, which is nothing, they
Nice.
that so they wanted to wait until deal with someone like Gemini now to implement it into Apple phones, I think, and that's quite smart. In my view, Gemini is the smartest one of those. So I think great move.
Dustin?
You know, I think Apple, under Tim Cook, his background was supply chain and logistics. While they are a software company, I think they consider themselves a platform company and a distribution company for applications. And that is very, very hard to disintermediate. And so bringing the best applications and viewing Gemini as an application that can support making their hardware product business, and their hardware product business actually generates a substantial amount of recurring revenue through their app marketplace. So anything they can do to make their hardware more desirable is better. And they get to avoid these massive, massive costs before they understand. Like in a way, it's kind of like let the first movers make their move and then see how much CapEx they actually have to spend versus some of the companies that are pure software. If they don't invest in these CapExes and the industry goes a certain way, they could be out of, disintermediated. So I think it's more that Apple has a unique position that they own the distribution channel, which is the iPhone and then the Mac ecosystem. And whatever, we're going to bring in all the apps and power the apps with the best technology.
Patrick?
I actually thought over the last 2 years, Apple got a lot of flack online for, oh, you're so slow, you're so lagging on the AI race. I have no idea what the rationale was internally. I'm not privy to any strategic discussions, budgeting, business planning. I have no idea. From the outside, though, I was thinking, hey, actually, if I were Apple, I would also wait this out. I actually think it's a very, very smart move to let others develop technology until it becomes not necessarily plateauing, but until it becomes sort of, okay, the marginal value of the next R&D dollar spent, we see it tapering off a little bit. Because you have this amazing platform, you knew that any great AI eventually would need and want to be deployed anyway to the Apple user ecosystem. So why would you start over-investing potentially in it as a latecomer to the party? When you miss the moment of, hey, I'm the pioneer, right? So when you miss that moment and you know you missed that moment, why would you then start a lot of money to try to catch up? In Google's case, that makes sense. That made sense because they weren't latecomers. They were always on the front. It's just that they were more research driven, but they had
for them to get involved, I think.
Yeah, so really for them it was just, okay, let's now switch it and expose it to our user base, but we have the technology, we have it internally. For Apple, that couldn't be said at the time. So to me, from the outside, not saying that was Apple's rationale, but from the outside, I was like, hey, that's actually great management discipline. I think that's a super smart move because you still have moat, you still have distribution surface area. Don't overspend, let others perfect the technology and then expose it to your users once you think you have identified the likely winner. It's so smart. So if that's what they did, but I think as a result, it's very, very smart.
I think there could be one other strategy at play here that isn't being talked about, is the appearance that Microsoft and ChatGPT are a solution for the enterprise. I know Microsoft has their Copilot as well, but because they have an investment in ChatGPT, it appears like, hey, we can bundle these and go after enterprises together. And I know Mac isn't traditionally at the enterprise, but they've always wanted to get in there, and more startups are using that. And so it does seem like an enterprise alliance could be worked through with Gemini and Apple being collaborators for AI and enterprise products.
I have some. I remember reading some time ago that actually Google were looking at this enterprise arrangement more, and they had released a product. I can't remember what it was, but it was like something simple like Gemini Enterprise or Google Enterprise or something like that for Gemini to be more enterprise friendly. Also, we spoke maybe a year or so ago about how the UK government was using Google. What's the Google Deep? Is it DeepMind maybe to do some to create some tools for the government in respect of planning application approvals. So I think that they're becoming this whole like concern. I think one of the things that people had this perception of particular Google products was privacy and whatnot. But the fact that they're now being used in government, they have an enterprise product, and now this announcement with Apple, maybe privacy concerns are like are for whatever it might be, are not so much of a concern anymore.
Well,
if they exist.
Well, just to double down on kind of what both Patrick and I have said, traditionally there is an advantage to being the first mover, but traditionally the first mover doesn't hit a bullseye. And that does allow someone that gets to watch and observe to come in after the fact and make the course corrections, because it's easier to course correct when you haven't built a huge product around something than it is to change a more developed product, because you have more information to develop it correctly. I mean, I'm fortunate that in pre-con, we get to see all of these estimating solutions that have been in market for 20 years and look at everything that they did that's wrong or not optimized and try to course correct those today. So there's advantages to being first mover and there's disadvantages. People don't like to call out those disadvantages. You want to be first to market, but we all know it, and it exists in both consumer and enterprise. We know MySpace used to be the world's most popular company, and Facebook smashed them. Facebook would have got smashed by Instagram, but Zuck was smart enough to buy that company.
Love the comparison. Do you remember that Apple released a paper? I've just looked at it now, but I don't know if any of you ever saw this, called The Illusion of Thinking. Did anyone see this? Where Patrick, I think you're familiar with it, maybe you understand it better than me, but I think the kind of abstract of the letter or the conclusion was that large language models were not smart enough to make complex decisions or complex reasoning.
I'm not treading that ice. I think that is too technical to be handled by anyone that is not actually an AI researcher. So let me not go there. However, there was that paper late last year where basically an Apple AI research team was arguing why LLMs shouldn't be powering a lot of, let's say, the ecosystem, etc., as much as perhaps the general public, be it stock market or wherever was already buying into it. So that was like a very high level summary. On the technical level, I'll leave that to the AI researchers to debate.
So the statement implying that the AI is not thinking, but it's just doing something similar, quasi-thinking, but it's still getting it right by doing so?
Again, invite an AI researcher.
Alan.
Yeah, he'll have some insights onto that. Well, apparently, I have some more kind of detail on this deal. Apple were testing their own internal models, but concluded that Gemini was much more superior and more capable for Apple's goals. Apple apparently pays Google. No, sorry, Google already pays Apple apparently $20 billion a year to be a search engine on Safari, the default search engine on Safari. And this deal is $1 billion for $1 billion for the Gemini licensing. So think about that.
Yeah.
Sorry, how much per year did you say?
20?
So Google pays Apple $20 billion per year to be the default search engine on Safari.
Sorry, just think about that. Okay, hold on. I'm glad I asked again. So just that I get it right, Owen. So Apple doesn't pay Google, right? You're saying Google pays Apple?
Yes.
Okay. So not only did Apple not invest as much money as its AI researching peers to invent models, it actually gets paid for not inventing models and distributed to its user base. So just that I get it right?
Yeah, and then gets the software at 1/20th of the cost that's being paid for the search engine.
Yeah. Okay.
Masterstroke.
All right. I'm glad I got it right.
How about? What does this mean? Well, I mean, maybe anyone doesn't have any hot opinions or thoughts on this, but OpenAI has to come into the question here, and I think that there was some light integration between Apple and OpenAI with some assistance and whatnot. But the fact that they've now gone towards Gemini, the fact that Gemini are now leading on all or the most popular AI tests when it comes to the large language models, where do you think this leaves? Or what would you be doing? Would you be panicking if you were Sam Altman at this stage?
I can jump quickly in. My competitive reaction would be that in the situation I'm now in, to continue thinking about how I can be larger and speaking about that, I would definitely try to get liquidity for my employees, because the moment my employees leave this business, this is not a company anymore that is worth anything, because that's the thing, right? So in the end, it's sort of the curse, right? So you were able to attract an uber talented cadre of people, very similar to, I mean, think about it. Sorry, just a quick detour. I was yesterday discussing with another investor. Just think about how many organizations can truly say that employee 1,000 is as good as employee 10, or even better. Go through your brain of the companies that you saw. Practically none. Palantir is most likely one of them, and most likely OpenAI could be considered in that group. I don't think Google could, by the way. I don't think so. I don't think Meta could. Mm-hmm. OpenAI perhaps. So back now to the thought process, right? That's part of the reason why you can do a lot of great things and can also have credibility when you speak of large ambitions, large visions, and then we're going to do this and that, is because in the end you can always count on you saying, well, sorry, but the very best people work for me. But you know what very best people also means? They got a brain. And they know that, hey, actually what my CEO is speaking externally, I'm validating with, my perception of my internal world, the code base, what my research days have done to me, and do I believe that is actually deliverable? And the moment I don't believe that anymore and I cannot cash out, then I fuck off. But if you allow me to cash out, I might stay on a little bit while longer, because it seems like the storytelling manifests in my bank account, right? So that's the second thing. I would absolutely make sure that my employees actually get secondaries. And for that, I need to tell a story of an IPO.
And at the moment they cash out, their interest and their focus goes somewhere else. So they become, hopefully,
you don't let them cash out everything.
No, exactly. You award them new shares, by the way. I mean, did you see the stock option program that Sam was asking for? I think what was it, like a 10 million per employee new share re-uppings?
Yeah, I think so. Something like that.
What does it mean, like to normal?
So he got approval from
person?
Sorry, I don't want to say anything wrong. So the reporting was that Allegedly, there was share stock option pool refresher that would account to a value of 10 million per OpenAI employee. I'm not sure if it's correct, whatever, because it is also maybe a month ago that I read it. But so you now re-up, right? That's how you keep the people. Let them cash out, give them new shares.
I will still never get over the fact that they can start as a 501c3 and then become a private business. That is.
Is that actually decided yet?
Well, how are they getting cash out? How would they be giving distributions to employees?
Yeah, I'm not sure. Don't know how they're structured that well.
I mean, that just shows the.
But there is court contesting, no?
I'm sure there is, but I think they'll get away with it, and I think it just shows how how effed up some of the systems are. Because why does Sam Altman get to do that, and every startup can't do that? Sam Altman gets to do it, and every startup doesn't. Complete crap.
Damn. Shall we go
Do you know how much more investable the startup ecosystem would be if every startup could start as a 501c3, convert to a business if they are successful?
501c3
it would be so much easier to raise capital. Yeah. Because the investor instantly gets to write off their investment as a tax deduction while accruing an investment interest. Becomes a much better asset class.
Why is
like
this allowed?
property in the US?
Well, property, you can't deduct the full investment. 501c3, you get to deduct it all as a write-off. You just donate it to charity.
How is this allowed? I suppose because they're...
I'm really interested in starting my own church in the US. Can we talk about that?
Yeah.
It's a wonderful thing. I mean, and charity is like, you can pay, you're the CEO of a charity. I mean, I think you're worth $1 million a year, don't you? How much funding do you bring in? $2 million a year? Yeah, you're worth 50% because you brought it all in.
Nice.
What would be your barrier to entry, Patrick, for new
patrons?
Yeah, patrons that will be.
Sorry.
What's the barrier to entry? What do they have to have?
Like Patreon?
As tall as you, or as like?
How are you going to attract patrons to the church?
Oh, I got it. Probably TV. You know, I always wanted to be a TV evangelist. I thought that was a pretty cool job. I came close to it with Bricks, Bucks, and Bytes, but I feel like I've yet to find my footing. But
what should we call
something in my future?
Call the new show Bricks, Bucks, Bytes.
Will this be a deviation of Scientology? Will this have an element of Scientology to it, Patrick?
I feel like we're pretty good in our asset class of having techno-optimistic visions of mankind, no? So I feel like we would be quite good at it.
Well, if you watch the large language model LLM debate Patrick and I done with Mike and Luigi, we did call Patrick praying for exits Hellerman. So maybe we'll have exits on the door rather than a cross. Okay, let's move to industry hot topics right now. So construction tech industry hot topics. Have you seen the news? I think so they filed. Okay, news headline is equipment share targets over $6 billion valuation in US IPO. They filed something just before Christmas as well, and maybe we mentioned it on this show as well. But now there's official release here from Reuters, which gives some more information on the deal, which states that construction tech firm EquipmentShare.com said on Tuesday, which was the 13th of January, it was targeting a valuation of up to $6.41 billion US in its US IPO, potentially setting the tone for a strong year of listings. Yeah, any thoughts initially, or should we go into what Equipment Share is and why this maybe is happening?
I have looked at the S1 brochure, so I have more detailed stuff. So why don't you start with just talking about the business first?
Yeah, sure. So it's a equipment rental company but they actually function more like a technology platform. So they have this thing called the T3 platform, which is an operating system for construction, and they install telematics hardware in each of their equipment, and this allows people to get more efficiency from the equipment, like on the nodes here, tracking location, fuel levels, engine hours, and driver behavior in real time. They also offer equipment rentals, retail sales, and services. Founded in 2015, have grown aggressively by opening bricks and mortar rental hubs across the US while layering high margin software on top of the physical assets.
So R&D for construction equipment.
Yes. So primarily a rental company with a software layer on top, which helps to then manage the fleet of equipment with great efficiency. There we go.
You know, I don't know the equipment rental team hardly at all. I think I've met one of the founders one time. It's a hell of a business to be able to do something in such a heavy asset class, like have to be in that asset rental space and be able to scale that is amazing. I suspect, well, first, I'm sure that they don't have any sort of things that are fundamentally different than United Rentals, but it's just really cool to see another company going public in what is a extremely challenging market to do that in because of the capital requirements and scaling difficulties. So good, hats off to them. Way to go.
Mm-hmm.
I mean, let's talk numbers, right? I think the numbers are impressive.
Yeah.
So they reported 3.8 billion in GMV, so gross merchandise value, basically gross revenue, in 2024, which is more than double what they had in 2022. And just for context, this is at scale, okay? So this is at a significant market share. This is at significant scale. So what is that, like 43, 44%, 45-ish of CAGR over a 2-year period? At that scale, that is absolutely tremendous. So that's fantastic. Then EBITDA margins. So in this case, EBITDA is a bit misleading because you actually have a CapEx intensive business, but is around 40% for all sites, about over 50% for mature locations where they have established businesses. So new sites being, okay, here's a new depot or a new dealership that I opened, you know, for mature sites is actually above 50%. So that shows that once you start up a new site, actually you can make it, you can improve the economics even more. The narrative with the T3 is one aspect to why they claim in the brochure, hey, we're being more capital light. The other one is because they actually, it's not financial innovation, but it's a very well orchestrated financial play. So when they purchase the equipment, they first take it on their balance sheet, and then they actually package it very similar to, I'm really now oversimplifying, but very similar to how you would package mortgages, and then you ABS it. So ABS is an asset-backed securitization program, and so they package that into SPVs, and these SPVs, they let public invest, well, it doesn't necessarily have to be public, but it can be. Institutional investors actually purchase tranches in this. And so these institutional investors like to purchase tranches because there is securitization with it. In this case, it is the value of the machinery. So if there was a default, you repossess the machinery. And they also, I believe, put in as a collateral the value of the lease agreement, right? So if you just pool enough, if you make it granular enough, and if you have a reputation of very low defaults, you can provide this way a very high quality ABS, and that way refinance your CapEx, which is a very smart move. So that's why I think they actually have a claim at being more capital light. There's one caveat to it. They first purchase it themselves. So that's why actually...
How much debt is on the business right now?
I think I saw a number 450, something like that. Let me see.
That's much lower than I would have thought.
No, let me just confirm. Can't see it right now. I can tell you later. The last ABS deal that they did, that's the 454. So the last ABS capitalization was 454. So pretty cool in that regard. I think there are also perhaps one or two more things worth mentioning that I hadn't taken a note of. Yeah, here we go. So earnings are not good. So they're not poor, but they're not good. So they actually still lose money on a bottom line basis. So in late 2025, they reported last 12 months minus 70 million on a net profit basis, which is, I mean, compared to a lot of other software or whatever companies that IPO'd, it's terrific. It's very, very good. But you're at that scale. You have an ops intensive business. You're not yet net profitable. So that's something that I at least am factoring in. And then the capital intensity. So first, actually, the CapEx is on your balance sheet, and then you move it by building the portfolio into the ABS market. Smart mechanism, but you first have it on your balance sheet for a while. So from a cash flow perspective, that is very relevant. You need to manage this business in a way where the intermediate debt cannot crush you. That's important because if there were ever a very substantial, really large downturn on the construction market, that cash flow from that debt and the principal can crush you. So that's something I at least am factoring in for these kinds of businesses. I know that because we have cloud manufacturers in the business. That's something that we had to get comfortable with and know a little bit how to help founders to manage that. Certainly the case here. In my opinion, this is a very, very professional organization. Totally impressed by it. Unfortunately, a little bit too old for to catch it with Fund 1 from Fundamental. But this is a terrific company. And I do think, by the way, sorry, before I go, I think somewhere it said that the target market cap that they were going for was above 6 billion.
And silly question from me.
Surprise.
Are all the construction tech or construction companies that go public, they are not profitable before going public? Because that one seems like it's not.
I mean, all is a big universe. So I wouldn't necessarily say all. I think in the West, it's very common. In India, for example, that would hardly fly. So in India, if you want to be a marquee IPO...
My guess is that there's not that much of financial engineering allowed or developed in less developed markets. So, because like stuff that you were talking about in the about equipment share, it's not just having a good business model, but the financial kind of.
So technically, Martin, financial engineering should only ever have an impact on maximum your balance sheet and your cash flow statement, but it should actually not show in your P&L. So your P&L should be immune to financial engineering. Now that is the teaching, let's say, because your net profit is what your net profit is. So hopefully by financial engineering, you do not mean things that people shouldn't be doing.
No. All the stuff, all the legal stuff, and like all of the.
No, on the P&L, there's not much engineering that you can do in order to in order to convert a 70 million net profit into something else. There's extraordinary effects that you can move in, so that works. That's also on a P&L basis something that does happen, but you then have to report it that way too.
We have 5 minutes or so before Tom comes in, and just to piggyback on the back of this, very much related, but as I was looking into this article, I found another article which was titled, "What Does It Take to IPO?" Shall we go through each of the points and see if we have any discussions off the back of that? So number one, revenue, the $200 million rule. Historically, $100 million in ARR was a gold standard to IPO. Apparently now that's more like 200 million. And that's not just about the quantities, or just not about the figure, it's actually the quality of that revenue. So how much of it is high quality recurring revenue with low churn. Cool, move on. Rule of 40, non-negotiable metric, growth rate plus profit margin should equal 40% or higher.
All right, so basically, whatever you burn, you need to grow.
And you should be even at 200 mil ARR, you generally need to be growing at 25 to 30% year over year. If growth is slower than that, profitability must be significantly higher to compensate.
What was the percentage again?
The what, sorry?
What was the percentage?
25 to 30% year on year growth. You must be a public company. You must be able to predict your financial results with high precision. You need at least 4 to 8 quarters of.
Not true.
Go.
Not
Say
true.
something.
Absolutely not true. CFOs, when they do their quarterly forecasting, have gotten, because I follow a lot of tech companies, have gotten absolutely lazy from actually making a prediction. So you'll see a lot of tech companies that they'll report, call it 700 million in quarterly revenues. Now, they also report that their net dollar retention on that, let's say it's all ARR, is 130%. And then you look at their forward-looking quarter, and what do they forecast? 700 million, which means that they do no forecasting at all because they already know they can beat that number. So not true. Absolutely not true.
Love it. Okay.
I actually think the SEC should investigate some of these CFOs or some of the numbers they put out there.
Give them a tip.
But what you're referring to, Dustin, though, is after they went public, right? So when
Yes.
they are public. So
Well-
I think, to be fair, I think they have an incentive to nail the 3 to 4 quarters before they go public between plan and, you know what I mean? And then you can start perhaps
gamifying your quarterly earnings. Like, we don't want to show a good forecast this quarter because we're going to do some things with our stock, and then we'll show a good forecast the following quarter, even though we have all the data points because we're a recurring revenue business and we know what our net dollar retention.
Nobody does that, man.
I will send you a list of companies of CFOs that absolutely do that.
Wow. Okay.
Yeah, 100%. Follow Twilio back in the day. They did it every single quarter. It was awful.
Okay, moving on. Yeah,
Twilio, to their defense, has some legitimacy why it would be a little more challenging, but like some of these companies, it's just atrocious.
Okay.
Like if you just count their net dollar retention, they literally cannot not make that number. Otherwise, they're forecasting. Otherwise, that would be a material disclosure. Oh no, hey, we know that our net dollar retention is actually just going to go from 125 to 100, but they don't disclose that. So there are some conflicting data points there.
Yeah, I hear you. Yep.
Yeah.
Why close it?
Why do they do it?
Why wouldn't they disclose this?
There's a certain strategy in that you always want to under forecast and beat. And so, but the problem is it's a communication nightmare. You should try to predict your forecast if you're a public company.
Okay, last 2 points from this article. By the way, I will link this. This article is written by Only CFO newsletter. So kudos to him for putting this together, or her. Last couple of points. Cash flow positive. Not every company needs to be profitable at the moment of IPO, but investors now demand a very clear, believable path to profitability within 1 to 2 years.
Well, a lot of tech companies are cash flow positive when they go public, but they are EBITDA negative because of stock-based compensation.
So what about Procore, for example, when they got IPO?
Procore was cash flow positive, but EBITDA negative because of employee stock-based compensation. They're barely cash flow.
Mm-hmm. You need a CFO who has been there and done that.
Well, that wasn't true for construction tech as well. Procore went public with a CFO who had never done it before.
Good for him or her. You need public-ready company systems and robust internal controls.
That's true.
And the IPO is not the finish line. It is the start of a new, much harder race.
Yeah.
Do not be fooled.
You're entering a different race. But you enter that race like a year or two before, like 2 years before.
And according to this article, there's a lovely quote at the top which says, "We are approx 2 years away from an IPO," quoted by every single VC-backed founder.
That's a bit
I don't
suspicious,
believe that.
but okay.
I don't believe that. I'd never heard any VC-backed founder say that to me.
No, but these are, I guess, early
Different
stage.
industry.
No, and early stages. Yeah.
Yeah.
I really wish IPOs were easier.
I mean, you could
the bureaucracy involved.
actually the
don't have
small cap and mid cap IPOs. The markets are there. The markets are there. It's
Yeah.
just that no VC ever pushes their companies there, and no company that is not VC backed considers it. Sorry, not no, but very few actually then have perhaps impulses or inspirations to pursue it. But actually, they're quite healthy. They're quite healthy. It's a good way to raise money.
Yeah, it's a good way to raise money. It's less dilutive than venture capital.
Oh, venture capital is awesome, man.
No conflict of interest on that statement. Yeah, debt from the public market versus venture capital.
You know what you can do when you do a small cap or mid cap IPO? You can list on NASDAQ CM. You can only trade 0.5 to 0.8% of your float and somehow find a way how with 2 million annual revenue, you get valued at 770 million market cap, and then you can purchase companies with shares. It's pretty cool.
That's where we're going wrong.
It's a new strat.
Sorry, if you just tuned in, you're not getting the joke. So you have to go back to the front.
Oh, it's a joke? Okay, all right. I don't know. Maybe Tom is running a few minutes late. I have something else we can dive into, which...
I actually know of a company that listed.
Oh, no, here
this
he
is. Oh, okay. Oh, hold off.
Hold up. Hey, Tom.
Hey, how's it going?
Hi, Tom.
Good morning. You're in the West Coast, right?
Yeah, I'm in San Francisco.
Nice.
Very cool. Okay, Tom, we caught up a few months ago, and good to see you again. And we caught up with you. You had some news in the middle of last year where you'd raised a $7.5 million Series A. That's right?
Yes, that's correct.
Okay, so why don't you tell us and our audience a little bit about Civ Robotics, like what you guys are doing?
Awesome. So thanks for having me here. Civ Robotics, we are automated construction layouts, mostly for outdoor construction sites, a lot of the heavy civil and solar construction. We literally take the blueprint and put it in the real world in real scale. If it's marking where the foundations for your solar farm and array is, or marking where the stop sign, the sidewalk, or anything we have on the road from a striping purposes as well. And even in large data centers and warehouses, where to cast the concrete, where the foundation work, where the formwork works. All these things need to be laid out in the real world so construction professionals can actually perform those tasks in the field.
Hey, Tom, perhaps, by the way, congrats on the round. Perhaps for everyone that hasn't been in that part of the market, can you walk us through real quick, without Civ, how does this work? What do people do? And then with Civ, what are they getting?
So before Civ, construction professionals will hire a surveying firm or have an in-house surveyor who will come out to the job site and use surveying equipment. Usually you see these tripods and laser beams or people walking around holding a pole and an antenna on top of it. So they would be walking around looking at a screen, which is guiding them where to go and where to mark the coordinates. And then these surveyors will go and mark at best 200, 300 points a day. And with our robot, they're marking 1,000, 2,000, depending on your accuracy requirements and outputs. So we're taking this skilled labor surveyor who's been doing this in the field for years, and a lot of them are actually trained surveyors professionally wise. Sorry about this, my dogs are being loud.
We like dogs.
Who let the dogs out?
So taking this technology and bringing it to the hands of the common construction people. We've trained people who used to be nailers, so like assistants with no prior education, or they're not that skilled to do the work much faster than their bosses. Like We take nailers to do 4x a skilled, educated surveyor. So we basically took this skilled labor, skilled task, and brought it to a position, to a point that anyone, I mean, it's anyone, without any prior construction or surveying background, can outperform people who've been doing this for decades, which is pretty crazy.
Cool.
Tom, it would be all nice if the robot could go everywhere, but obviously they cannot. So what about if part of the path is nice and easy for a robot to access, but some areas are impossible for the robot to access? Can the data be exchanged between the surveyor and robot in a real time so that some measurements can be done by surveyor?
Look, on the project that deploy us, typically our robots are able to perform about 95% of the work. And let's say you have a task with 10,000 points. When that robot has completed his task, all the points that it's not able to do, for whatever reason, if it's under, inside the trench, or there's a bundle of materials right there in its way, the robot report will show these points were not marked and have to be mitigated manually. Out of all the projects we've been deployed on, and the number, I don't even know, like close to 200 right now, probably. Only one job the robot was not able to actually be deployed on. And because it had these weird environmental things, that the robot was not allowed to go and cross into a bush. So if there's a bush in the way, you have to drive manually around it. I'm like, the robot, the whole point, it's an all-terrain robot. It's a four-wheel drive. It's like a buggy. It will just drive past it. No, they did not allow it. So the output was affected dramatically to a point that did not make sense. Like, if the robot is not going to outperform the manual surveying, we should not, it should not be adopted in that job. That makes sense. So it is an all-terrain system. It is like a buggy. So if a buggy can go there, we can go there also. We have in mud, in sand, in desert land in Saudi Arabia, when the temperatures are so high that they only work for 3 hours in the morning and 4 hours in the afternoon, all the way to snowy Indiana, deep in the snow after a snowfall.
Tom, could you give? I have two more directions I want to go. We only have a few minutes here, but number one would be like, could you give us some cost comparisons? Like, what's the cost of I don't know how you price it, but maybe it's like per point marked versus robot versus human or something.
So the point mark in the US, depending where you are in the how and the scope and magnitude of the project, it's typically between $5 to $10 a point. With us, typically below $2. And even that price really depends on the type of marker and labor costs you have in the region. On some regions, people pay $15, $20 an hour. Some regions, it's $50 to $100, depending if it's a union job. If you choose a nail, that's 50 cents. If a flag, it's 10 cents. So all these things have a direct impact on the cost per point, while sieve portion, with the volume that we have, is typically less than half a dollar. So it's pretty remarkable how, I had a customer who lowered his cost to $1.20 with us.
That's just compelling, huh?
But it's less about the money; it's also about the quality, and knowing that you can get the job done with one instead of 4 or 6 people, for instance, in a very time crunch manner.
Yeah.
On a road closure, you could have a surveyor work for 5 hours, and you give the surveyor an hour or 2 hour buffer to do the layout before you can start doing the work. With us, give it 5 minutes. So you actually have almost an hour and a half more to actually do construction at night closures with road pavers.
Yeah. Very cool. One last point from me, and anyone else feel free to pop in. But we spoke last week on here about JLG acquiring Canvas Robotics, and I'm very curious as to what you view a company like Civ Robotics' exit strategy to be in such an industry. Yeah, I'll leave it there.
So look, there's a few large corporations and organizations in the construction space that can take a product like Civ and expand it even more from a sales perspective to their customer profiles. Of course, the surveying technology companies, but also the equipment manufacturers of the heavy machinery. Civ is very fortunate to have already 2 strategic investors, Trimble and Bobcat. Both have, of course, potential exit and do some acquisitions in the past. But also, since we are very, very heavy involved in solar, there are also solar manufacturers and OEMs and robotics companies who can also be potential acquirers or even developers. We have customers that have been using us in the field, and we've saved them millions of dollars. And there's more to come as we just launched our new product for material handling distribution, and also more autonomy to come. So I would say there's 3 angles for any construction tech startup for an exit. It could be a strategic, it could be a customer or an industry affiliate, and it can also be a OEM or technology partner that can take your product as well and integrate to their customer profile from a industry standpoint, not necessarily from a product standpoint.
Very cool. Any of the others want to chip in with a question for Tom?
Tom, what's next for Civ?
That's an amazing question. Expansion in the US and abroad. We already have robots deployed in Saudi, in UAE, in Portugal, in Spain, in Italy, and Australia. We're shipping now to Turkey. So expansion globally with our product. If it's in a crate, and we ship it out. And from a product standpoint, we have already launched the Civ Nav for material distribution, and we have also autonomy for that as well coming out. So we have a skid steer here in California that's driving without an operator, stopping within an inch, and dropping material in the field. So that's coming out. More to come with autonomy to our customers who we're here to solve their problems, and we're here to help them to get things done faster, more precise, and more efficiently. So just like a lot of surveying companies, technology-wise, started out with surveying technology, with the handheld and the GNSS receivers, Civ is going towards machine control, machine automation, and helping our customers get the job done.
Nice.
What about the drones? Are you planning to use drones for surveying solutions?
Funny that you asked that, Martin. We actually started with a drone. So our first company actually was called Civ Drone. And after developing this really cool drone that puts sticks in the ground, which I still have one here in the office, we killed it. It did not make as much sense. And we decided to take this technology and problem and solve it from the ground. So with the drone, we were able to reach 500 points a day with a lot of batteries and a lot of skilled labor. And today we have customers reaching, the most I've seen is 5,000 points a day. Most are doing about 1,200 to 2,000. So with not skilled labor. So I'm not going to go back to drones. I don't want that risk upon myself, and learn from your mistakes and move on and grow.
Very good.
Sounds good.
All right, Tom. Yeah, thanks so much. Good way to end that. Yeah, good luck, man. And hopefully see a Civ Robotics on a solar farm near you soon.
Thank you for having me. Have a great day.
Best of luck, Tom.
Bye-bye.
Take care, man.
Thanks.
Very good.
Well, it looks like we got something to talk about.
Breaking news.
Yeah, I know, Patrick, we need to wrap up. I will need to wrap up in a few minutes, but yeah, Dustin, why not? I just got a message with some breaking news. You want to break it?
It's on the website, so very interesting. Tracy and Ralph, founders of PlanGrid and founders of a company called Tiger Eye. Tiger Eye was just acquired by Lennar Homes. So congratulations to Tracy and Ralph on another acquisition. The dollar value is not yet public. Don't know if it will be. They had recently pivoted from a sales intelligence platform, I guess that's the term, to focusing on construction and AI. But it looks like they're just going to join the Lennar family, which Pretty
Is
sure this
Lennar
is
the
more of a
largest
talent.
developer in the US?
Lennar is a developer. Yeah.
Yeah,
think
they're
that-
one of the largest. There's like 5 publicly traded home developers. They're one of them. I don't know who has the highest market cap, but I'm sure this was a talent acquisition at this point. Bye, Patrick.
Sorry,
Ciao,
I got off,
Patrick.
guys. See you next
See
week.
ya.
Bye.
Take care. Bye bye. Yeah,
Yeah, so
crazy.
sure.
Hey, Tracy, if you are listening to this, come and tell us all about it next week. Would
text
love
her.
to hear the story. But yeah, we could have a look at this next week. Interesting times.
Yeah.
Okay, guys. Thanks for your wonderful hosting. And I guess we will see you all next week.
All right.
Thank you.
Peace out.
Bye, everyone.
Bye.